Okay, hey everyone, it is Ian, and today we're going to be going over a similar trade idea that we have brought up before, basically looking for inefficiencies in the markets, looking for overpriced risk premium wherever we can find it, and trying to find the best positions that will capture that inefficiency. But we're also going to talk about something else today, which is getting the most bang for our buck if we need to hedge. A little backdrop before we really get into this trade. I want to go over hedging and when to hedge, basically. Okay, what we typically would want to hedge when we believe that there is a chance of a huge blowout, right? Is the only time that we would ever want to do it because the transaction costs are additional and we have to pay a premium to get a hedge on. Now, there's other ways to mitigate hedges, but they come with their own risks. And we're going to go over those in a minute. But I just want to go over why we typically use hedging. So with that out of the way, let's break down the trade. The trade is on FedEx. Okay, so FedEx just came out with a pre-release yesterday. And what they basically said in this pre-release was we're expecting a global recession. We are beginning to scale down our production, scale down our stores, scale down our flights because we don't need them. Okay, and we have seen what this has done to FedEx, guys. I mean, look at this. We had FedEx closed yesterday at $205. Today is around 161. This is an absolute huge drop. And historically, what people do on pre-releases is it's basically the event. Not fully, but a lot of the key information for that upcoming earnings call has been released because they don't want to surprise their investors on the call. And that is what we saw with FedEx. They completely slashed their EPS guidance. And obviously, like I said, look what happened. So, what we've seen is we've seen implied volatility still go up. It's still going up. Now, is this just because, we had a huge rush in gamma, a huge drop off in the price, right? We know the volatility clusters. Or is this a one time deal? Right? Is this a one time thing and investors are just scared and we can take advantage of this fear? I'm going to opt it being the second. Typically, the event in itself, post pre release, right? So, like, let's say a stock is reporting their Q2 earnings and they pre release their EPS, their forward guidance, and their revenue, right? It's basically what happened with FedEx. Usually, the event basically has no volatility because all the key information, all the key components are already known. So, I would expect something similar here with FedEx. Now, let's break this down. If we go over here to the relative value tab and we just plot out a basic premium on this thing, right? So we're getting FedEx 30, FedEx RV30. Now, I want to be sure that this is going to be a little bit skewed. So just keep in mind with this, okay? What we can see is that it appears that's in the higher end of its range, excluding, a few instances where we had run-ups, and this was most likely due to earnings. So if you wanted to, you could come back in here and just go non-event IV30 to realize volatility for the past 30 days. You could do non-event realize volatility too. We can see that this is definitely in the higher end of its range. And this is important because non-event IV30 going up, right? This rising has nothing to do with that earnings event, even though that is going up as well. It's important to note that. Basically, what's going on with FedEx is we're seeing a stock that is having a huge rush in implied volatility, but the book is on the ground, so to speak. Okay, and what I mean by the book is on the ground, I mean the information that was going to lead to the volatility from the earnings event is out. It's out. Vast majority of it is out. So I don't think that we should, be seeing a surge in implied volatility, right? At least I don't think so. So at least this is our view, or at least my view, that is, that we're seeing an inefficiency here, that we're seeing something that could be overpriced, could be expensive. So how do we take advantage of this? Let's go in here. Let's go to FedEx. All right, there's a couple ways you can play. FedEx is currently trading for 100, give or take, $160, right? So got a straddle in here. priced out at 155, if you wanted to, and I'll actually come back to that in a sec. But let's just go to 160. This is the first trade idea. You can just sell an at the money straddle, right? Your vol adjuster would literally just be your components right here in the predicting alpha terminal. So I'll actually show you guys how this works. So let's go back to the volatility insights tab. Go here, ticker, go up FedEx, right there. We can see that our forecast volatility for 30 days is, we get that up here. Now, like I said, remember that, and I know that someone's probably thinking this, well, they have an earnings event. My point being is that I don't think we're going to see a lot of move on the earnings event because all this information's out. So if we go here, we can see that our forecast volatility is 31.51%. So what we do, come in here, go into your Thinkorswim or whatever you use. It really doesn't matter what you use, guys. It really is, that's all subjective. You can use, trying to think what you could use. You could use IBKR, I guess. I think E-Trade has something similar. So, nevertheless, doesn't matter what you use. We adjust our volatilities, and we can see that max, our P&L with this is going to clear a pretty good chunk. I mean, we're talking, if we, don't see much action and volatility starts to come into our forecast, we're looking for a pretty solid payday here, right? But I want to talk about this subject, and this is a very crucial subject. And for people that aren't familiar, I'm going to try to explain it the best I can. There's a thing called post-earnings announcement drift. Now, remember, this isn't an earnings event, right? What happened yesterday was not an earnings event per se, but it might as well be an earnings event because they released information that usually goes out on the earnings. And usually what happens when you have a huge blowout in a given day, like think like Snapchat, actually let's actually pull up Snapchat. This is a pretty good example. So we can see right here, Snapchat, huge blowout last year on their earnings. Drift, 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 down, 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 down. Right? Another huge blowout here. Drift, 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 down, 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 down. Another blowout here. Down, 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 down. So the point is that there's a thing called post-earnings announcement drift. Basically, it's when you see a huge blowout in the earnings, right? Like a stock goes up 20%, down 20%. Market, let's say it was implying like 5%. What happens is it typically continues to move in that direction for a period of time. And because the market is still absorbing that information for whatever reason. Okay, now, is it as effective as it was, like 10, 15 years ago? That's debatable. Nevertheless, if you think that is a risk, then we need to talk about hedging away that risk because we don't want delta exposure, right? We want to mitigate the drift if you think that there's going to be drift on this. I can't really tell you if there's going to be drift on this. I just, offering up an idea here. There's a couple ways you can play. Number one, you can do what I talked about, which is you could sell a straddle that is a little bit further away from the money to the short side. That way, if we do see a little bit of a drift, or we see, further bearish information on the earnings call, well, hey, look, you're in good shape, right? But here's the thing: to go back here, go back to FedEx. There's something really important that I would like to show you guys. Spot vol correlations are very negative on this thing. So the problem that you have with that is that, sure, yeah, great, implied volatility is coming down, volatility is coming down. We should expect the stock to rally then, based off this negative beta of negative 1.68, give or take. So maybe that isn't the most optimal, right? Maybe this isn't the most effective. So what can we do? Let's say we go back and we sell the at the money straddle, right? We have our at the money straddle. What can we do? Could we buy a put? Yeah, we could buy a put to hedge the downside. But here's the problem, guys. Put up the skew. We see the skew is relatively, it's pretty high. It's around 3.22. That's not exactly optimal either. Not just that, we're buying even more expensive, right? So let's say we're selling a 160 put right here, right? At 43 vol. And then we buy like a 150 put. We're buying vol at 47. We don't want to do that. So what can we do? If selling a straddle a little bit out of the money to the short side isn't a terrible idea, but I think there might be something better, and buying a put on this is certainly not good, then what can we do? I may or may not be giving it away right here. I accidentally forgot I had this open, but yes, UPS. Wait, Guys, UPS doesn't have earnings coming up for until like the end of October. And UPS isn't FedEx. Why am I bringing up UPS? Here's why, guys. Here's why. Ready? Let's go to the correlation tab. UPS, FedEx. Run it. And watch this. So that's up. Just going to get both of them up here. Boom. This is why. Beta of 0.86 between the two, between UPS and FedEx on the regression. This right here, the chart time series, for the prices, we can see that they typically do move in tandem. Another thing that we can see is that these are extremely correlated assets. A 0.69 correlation reading between the two, which would make sense. Think about it. I mean, UPS and FedEx are very similar companies, very similar business models. And from the fundamental perspective, think about what FedEx talked about, on their pre-release. They talked about the overall macroeconomic risk. It wasn't like something particular with FedEx, like, oh, we're bleeding out because of debt and we structured, a bunch of our investments terribly and our cash flow is depreciating because of accounting errors. No, no, no. That's not what's happening. They're talking about macroeconomic risk. So one could infer that what's happening to FedEx is probably going to happen to UPS too. And already they move in tandem and have this extremely high correlation rating. So what we could think is, okay, then maybe UPS might be a little bit cheap, right? Maybe UPS is a little bit cheap. Maybe we can hedge, with UPS, right? And again, this is only if you think hedging is appropriate. If not, there's really no point in doing it. We can see that UPS non-event IV has also gone up, but we can also see that FedEx IV is accelerating more rapidly. And we can see that this is, pretty much fair value in the range, but FedEx IV is more expensive than UPS. However, if FedEx blows out on the earnings call and continues to cite macroeconomic risk, there's a pretty high likelihood that UPS is going to go down. So look at this. UPS is trading at 176, give or take. We could buy, if we price out, like just a one standard deviation put, right? So we have 650 here, and then we go over here, and we have, sorry, I gotta call it over, around $8, right? $8, $6. We're just gonna go, with 14, so $15. So that's gonna be 160. So there's 160 put, right? So a give or take one standard deviation away. We're getting this put at 36 ball, right? Versus UPS or FedEx, which if we go here, trade at 160, we can see that is going for 850, 950. So that's around 18. So it's going to be like $20 wide here. So it's going to be around 140. We'd be buying that at 51 vol. And in terms of like dollar terms, this put's actually more expensive than the UPS put. Now, I'm not saying that just because, let's say FedEx drifts down or FedEx has a really bad earnings event, that it's for certain that UPS is going to go down with it. I'm not saying that. I'm saying that we should expect it to. How much, I don't know. But this is just a good precautionary hedging idea that I thought some of you guys might find a little bit interesting. Obviously, there's a million different ways to play it. Just want to drop in that idea. So to recap, we think that FedEx IV might be a little bit overpriced. There's really no reason for this huge pop in IV that we're seeing for the earnings event as well coming up next week because a lot of the information is already out there. Like I said, the book is already on the ground, right? It's like a book fell off a desk and it's already on the ground. It's done. The event happened, or a majority of it. So like 90% of the book. You get my point. It's already on the ground. The rest of it is just noise. So I hope that you guys really found that interesting. I hope that this is at least an interesting idea of finding new opportunities, taking advantage of maybe what could be a lot of overreaction in the markets, a lot of fear in the markets. And like always, if you have any questions, feel free to message me. And with that, guys, have a great weekend.